So this chapter is going to begin one part of two chapters discussing how we handle companies that have merchandise or have inventory. There are easy companies when we deal with services because you're not necessarily selling product. But companies that sell product have an extra step in the process because they need to keep track of not only the income they make from those products that they sell, but they need to keep track of their inventory and which products are associated with being sold. So we're going to talk about how we handle the accounting for merchandising today. We're going to talk about what it means, merchandising accounting. We're going to talk about a couple different types of inventory methods. We're going to talk about a new type of income statement that relates to merchandising companies. And then we're going to prepare income statements associated with that. So we're not going to worry. Merchandising companies are those companies such as Macy's, Home Depot, who can think of another? Cub, Target, that basically, what? Walmart, that sell inventory. They make their money by selling goods. So it's a merchandising company. The buying and selling of goods creates a little more accounting uniqueness, or as they call it, complexity, to the whole accounting system. So basically what we need to do is really understand how we go about the process of showing purchasing merchandise, holding it, and then in turn selling this merchandise. There are two methods that we use in the merchandising system. One is called the perpetual method. The perpetual method is actually the method most companies do use today because we are so savvy or sophisticated with our inventory and computers that we can always keep track of what is on hand at any given time and what is available at the end of the year. So under this method that we call the perpetual method, inventories are continually updated after the end of each sale, and we can always know where we stand at the end of the day. So we always know what's been sold and what's still on hand. Another method, which is easier to handle, we call the periodic inventory system. This method is a little more archaic, if I can say so, where we don't keep track of the inventory that's sold until the end of the accounting period when we take an actual physical account, and then we can at that time determine how much has been sold throughout the whole year based on what's left. Under both methods, we will take a physical count at the end of the period. But under the periodic method, that physical count really helps us determine what is on hand at the end of the year, so it helps us to see what's basically sold. So know that two methods are used, the perpetual method and the periodic system. So under this perpetual method, we basically can, in a perfect world, determine what we can buy because of what's on hand. Now, if any of you guys have gone into a store, you know it's not always foolproof. We went to Menards, this is several years ago, and we were buying bookshelf, or it was like a closet organizer, and they told us so many of each piece was on hand, and yet it wasn't in the store. But it's better than the periodic method. I know I was at Macy's about a year ago, and I was looking for a certain dress in a certain size. They said, well, it's here, and I dug through every rack and crevice, couldn't find it. It might have still been there, it just wasn't where it's supposed to be. But it is a nice system because it really does provide more information to the customers as to what's on hand there. So perpetual systems are what most companies are using, and it basically allows managers, if something needs to be reordered, they know what's on hand and then what needs to be ordered. Under the periodic system, it's easier to use. You don't have a constantly updated system that keeps track of what's on hand. It's more utilized for smaller companies because they don't have that sophistication in software. So we're going to talk about what's involved in preparing financial statements for this type of company we call a merchandising inventory company. One type of income statement you will not see for a service company, but you will see for a merchandising company, is called the multi-step income statement. This multi-step, or it's a series of steps that gives you various types of information regarding the gross margin or operating income, gives you a little more information on the income statement. So basically what happens in this multi-step income statement is, as you see this breakdown on the slide over to the right, a merchandising company starts with their sales, their gross revenues. Then they take cost of goods sold. So it would be sales minus the cost of those goods that they had to pay for them, cost of goods sold. The difference between what the customers purchased them for minus what the cost of what those customers purchased at their price is called gross margin. That's going to be the difference between what they bought them for versus what they're selling them for to you. Then that gross margin minus what we call operating expenses is going to equal something called income from operations. Then we're going to have a series of either expenses or income accounts that aren't related necessarily to the operations that we put into account here to come up with net income. So as you can see here on this slide, a merchandising company has an extra step there. They have a cost of goods sold step that more normal service companies do not have. And then they have something called gross margin that also normal service companies do not utilize in the preparation of their income statement. So that's what we're primarily going to talk about today, how that works. Here's an example of a company, and this is a merchandising company. And as you see here, the first portion of this shows gross sales. Then it tells us what was returned. How many of you guys purchase something but it's not exactly what you want and you return it? Happens a lot. So this allows us to see that amount of items that got returned to then come up with what we call net sales. The gross sales minus the returns gives us our net sales. Our cost of goods sold would be those items that customers purchased, what the company purchased those goods for, that inventory for. The difference gives us our gross margin, kind of like what we call the markup. Then from there, we're going to take various operating expenses and we classify them into some categories. One is selling expenses, one's called general and administrative expenses, to give us our total operating expenses, and then from there we have something called income from operations. Then we've got our other revenues and expenses. In this case, this slide shows us interest income they maybe have from various investments, and then interest expense they may have from various liabilities. And the bottom line is going to be the same as our service income statement, net income. As you see here, it's just breaking it down into more of a organized steps to give us some information along the process. So the way we calculate what we call net sales, we're going to take gross sales, which are all the sales we've received, minus any sales returns. Now there's something called allowances. A lot of times allowances will happen because of quantity purchases. If someone purchases, say, 50 items instead of 1, the company may provide for them some type of allowance or discount based on that purchase. So sales returns and allowances can provide for discounts. Gross sales are all the total cash sales or credit sales during a period. And then our sales returns and allowances are going to be any refunds or credits we provide or discounts. Okay? Why do we want this? This information gives us, having it broken down like this, gives us more information. It allows us to see how many people are returning items, and then we can really hone in on which items are getting returned. Could it be that we got a bad batch, and then they can hone in on what the bad batch was? Could it be we also see where people are taking advantage of discounts? So it gives us more information than just a normal income statement would give us. So with this company that we had on the previous slide, it shows us our net sales starts with our gross sales, all the money we got in from customers, minus our sales returns and allowances of $52,300. That ultimately comes up with what we call our net sales. The next step of this income statement deals with the cost of goods sold. This isn't all the inventory we've purchased. This is only the inventory we've sold during the period. Cost of goods sold is the cost that the merchandiser, not the customer, but the company paid for the merchandise that's sold during the period. They need to pay less for the merchandise than they sell it for so they can make a profit. Make sense? If it's a manufacturing company, not a merchandising company, a manufacturing company manufactures the goods that they sell, or that they in turn sell even to a middleman. So for a manufacturer like a 3M or like a Polaris, that would be the cost of what it costs them to make the products they turn around and sell. So it's a little different format, it's a little more complicated. Merchandising, they purchase their products, they don't do anything with them in order to sell them. Merchandising companies purchase the raw materials, they have factory assembly lines, they have labor to help create those products and then turn around and sell them. For this company that we're looking at, Davila, it shows on our income statement that the cost that they paid for those goods that they sold was $815,040 during this period. The difference, the net sales minus the cost of goods sold, gives us something we call gross margin. It's really going to be the difference between what we got and what we paid for it, the gross margin. We always hear of markup, gross profit, gross margin. They're all interchangeable here. So Davila, their gross margin is going to be their net sales minus the cost of goods sold is going to give us their gross margin. Many people are interested, most managers are going to be interested in the markup, or what we call the percent of gross margin. What do we mean by that? Basically, if we take the gross margin, which is that bottom difference, divide it by gross or net sales, we're going to see how much we really make on products we sell. So for example, we are purchasing this computer. I just went to Best Buy and bought this computer last week. We bought 2 of them actually. I bought it for, say, 750 bucks. Okay? So the sales would be 750 bucks. What would you estimate Best Buy bought this for? I don't know.
750 bucks.
You think Best Buy bought it for 750?
Because they gotta have a profit, they gotta have a markup profit, so they probably,
Alan knows.
Why?
it's something to draw you in. It could be something.
Is that what it is? Something to draw you in, Zach?
Typically on the big items, there's like no markup at all.
How do they make money, Zach?
Accessories.
You're right. Those accessories kill you.
So,
Okay, so are you telling, and this was exclusively made for Best Buy. So you're telling me that Dell sells it to them for roughly $750 and then they turn around and sell it for the same just so they get us in the door?
Markup that might be on that would be probably around $25 to $30.
yep.
That's nothing. All the overhead. But I would agree with you. Those accessories
Your
are,
Microsoft Office, it's your Word documents and things like that. It's all of that stuff. Cases,
the cases
protectors, all that stuff.
is how they make money, and yet they're small items, if you really think about it.
See, you gotta ask the Best Buy people.
No, that is so fascinating. That's why Best Buy's hurting right now. They can't keep up with the online sales. Because they've got,
We have online stuff.
they do, and they're trying to really push that. And you know, I just had a client in yesterday from Target. They're laying off a ton of people. She's in the online end, and she says she probably won't get laid off because that's where they're making money right now. Or that's where they're trying to expand too. That's so interesting because if I go to Best Buy, this is a good point though, if I go to Best Buy and I go to Dell, you know, the prices are pretty equal there. Very
We
interesting.
also drive by price matching.
You have to, just to keep the business, huh? Very interesting. Guys, you see how we learn something every day? So the gross margin is really, okay, so we're not going to take this computer. Not a good idea. What about my snowball? This is called a snowball. This is a little microphone. Now, I must admit I bought it through Amazon.com. Right now, they're going for about 80. At one time, I bought one for 100. I got this one for about 55 bucks. My guess is when I bought it for 55 bucks, it wasn't a great big markup, whoever I bought it for. But when I'm buying it for 100 bucks, and let's just say the cost of producing this is 53, my gross margin is going to be 47 bucks. So our percent of gross margin would be the 47 bucks divided by 100, or 47% is the markup on this product if I bought it at 100. Now, when I buy it for 53, and when I'm buying it for 58, and they're purchasing it for 53, what's the markup? $4 divided up by 58 bucks. Not a lot of gross profit percent of markup, is there? Make sense, guys? So I want you to know that the percent of gross margin is going to be equal to gross margin, divide that by net sales. Okay? Now the next group in our little income statement is something called operating expenses. This is truly the cost of the company, the cost of why the company's in business. Operating expenses are going to include the cost involved with running the business. They can be selling expenses, general and administrative expenses, salaries related to, well, selling expenses. And so for selling expenses, this might be warehousing the goods, the cost of the warehouse, getting them ready to sell, advertising, delivering the goods to the buyers. The general and administrative expenses are going to be all those other items. All that peripheral activity that needs to happen in order to have a business, collections, accounting, HR, anything else related with the business. So when we deal with this, our gross margin minus our operating expenses is ultimately going to give us something called income from operations, or we could call it operating income. That is going to be just our gross margin in that next series of steps, the gross margin minus all of those expenses related to operating the business. Any questions on that so far? Does that make sense to you guys? Yes, no? Which Best Buy do y'all work at? Apple Valley? Do they make money there?
Yeah.
Do you get paid well?
Yeah, for what we do,
Competitive pay.
Is it, but it's not based on commissions, is it?
nope.
Do you guys get a benefit based on selling warranties? That's how they make their money.
We personally do not. Best Buy does, but we don't.
But you don't. But they really...
No matter if I sell $100,000 in a week or I sell $1 in a week, I get paid the exact same amount.
But what about warranties? If you sell warranty
It just
contracts,
looks better for us.
it looks better. But it really
It looks
doesn't.
better, but we don't get paid any more or any less money.
That's interesting. That's really too bad, though. You would want...
It's two-sided. So it's two-sided because
If you're working for the sale and you're not there the next day and the person comes in to buy the next day, it can really
make you mad.
your
Yeah,
relationship.
that would make sense, too.
And then also it allows us to be open and honest with people and go, that's not a good something for you to buy.
Which is really true, too. I do get that one, too. Okay, so as you see here in our example, the income of operations for Davila is going to be their gross margin minus their operating expenses. Is going to give us the income from the operations. Then we're going to break down other types of revenue and other types of expenses that aren't necessarily linked with the company making a profit, but it's other types of income and expenses associated with the company. These can include dividends, interest, so those are revenues. It can also include various expenses and borrowing money. So after those additional income and expenses, we still come up with the bottom dollar net income. That's the same as it is in a service company, isn't it? But to get to it, there's a couple more steps in the merchandising company. So again, if we look at it, our net income is going to be our gross margin minus the operating expenses plus other revenues minus other expenses, which is going to give us our net income. So we kind of went through everything involved in creating what we call a multi-step income statement. That's the most desirable type of income statement for merchandising companies. The single-step income statement is much easier. We basically categorize revenues, categorize expenses, but we don't separate out all these items we're talking about. So as you see here in the single-step statement, as you see right here, we take our sale, all of our revenues, we put them together. We take all of our costs, put them together, and we have a net income. It's giving us the same type of information, but it's not breaking it down as in the multi-step statement. So I want you to know what the difference is. Single step is easier to do because you don't need to know what are operating expenses or what are other revenues and expenses. You just lump them all together. Make sense? Okay. I am going to take a quick minute and we're going to go and pull up some problems. Okay? So I'm going to go into my little Course Smart. Okay, where is it? Principles, where the heck are you? There it is. Nope, that's advanced accounting. Here it is. Okay, what page do we start on, guys?
236.
Thank you. So, let's look at SE3. I want you guys to take a minute and based on the information on SE2, I want you to follow and prepare a multi-step income statement. So let me find online here. Here is on page 209. Here is a multi-step income statement. So I want you, based on the information on SE2, to go to your page 209 and I want you to prepare a multi-step income statement. How many of you guys think you can do that? Okay? Let's take 5 minutes and do